In this lecture we are going to analyze a long trade in the USD yen. This example has a little bit of complexity involved in it, and it's not the easiest example of market manipulation you will find. The reason for that is the complex line work involved and the rather violent price behavior for both sides of the market. Without further ado, let's jump right into the analysis. From number 1 to number 4 you can see the market clearly rising in what we usually call the major flow, but from number 4 to number 5, some different things happen to confuse the majority of traders attempting to trade this market. The first thing you should notice here is that the vector from 4 to 5 represents the formation of an expanding pivot. That's because 4 is higher than 2 and 5 is lower than 3. This tends to confuse the natural intuition that higher highs and higher lows produce an uptrend and that lower highs and lower lows produce a downtrend. At point number 5, there is a lot of indecision in the minds of traders who follow this simple notion of highs and lows to roughly determine the trend. However, in the minds of retail traders that look for highs to buy and lows to sell, the break of low number 3 represents a selling opportunity that was indeed fulfilled. What these retail traders fail to realize is that vector 5 was intentionally driven down by large traders because they know that there was a cluster of sell orders right below the low number 3 as a result of retail traders who attempt to go short in these obvious breakout points. The very first confirmation sign that this was a tipping point for large traders to throw retail traders off the cliff was candle number 5. Observe how violently candle 5 returns to price levels above low number 3. Candle 5 was exactly the moment where large traders got into this market after creating a deep liquidity pool by hitting the cluster of orders that used to live below number 3. The series of green arrows you can see on the chart represent the mildly organized behavior I talked about briefly in the theoretical portion of the course. This organized behavior is a sign that large traders are actively pushing the market higher and higher with each candle that is formed. You can see how far they went with this by looking at the volatility of those bullish candles marked by the green arrows. However, before we move on to the next steps of this manipulation, let's roll back to its very beginning where the von Restorff effect took place. In this specific case, the von Restorff effect was quite subtle, and it happened from point 4.4 onwards. Observe that the market starts cascading down after that point. This gets the retail traders who were looking to go short in low 3 all agitated and excited about the strength of the market on the way down. Needless to say, this is all a theatrical maneuver to trigger precisely this sort of reckless and impulsive excitement in the less educated traders. The market vector from 5 to 6 creates yet another expanding pivot formation because 5 is lower than 3 and 6 is higher than 4. Similarly to what happened to those retail traders in number 5, the retail traders who were looking to go long at the break of high number 4 got exactly the same treatment from number 6 onwards. Both sides of the market ended up being washed out of their positions, so you might ask where exactly we are supposed to trade here. When it comes to trading market manipulations, the devil is always in the details, and the places where you can get in the market are not always obvious since this is a complicated game to master. This is where we have to employ the principles of complex line work and reverse engineering of market contexts. If you observe on the chart, we have a few sloping lines drawn at specific places. In a first moment, these lines might appear to be randomly drawn, but that's not the case at all. The first set of lines I want you to pay attention to are the two upsloping black lines. The first line comes out of high 4.4 and extends itself until high number 6. The reason behind that is that 4.4 was the very beginning of the manipulation in the subtler von Restorff effect we talked about. High number 6 can be considered as the last leg of the manipulation. Observe also that an upsloping black line with the same exact angle was drawn in low 4.5. You might be wondering why this line was placed there, and the reason is that that was the last low before retail traders got maneuvered. Beyond that, drawing lines in the last minor extreme before a major extreme can be useful to identify secondary entries in the market. The other set of lines you can see are the orange lines. The first one comes out of 4 and extends until 6. A line with the exact same angle was drawn out of low 3. These are just the most important extremes of price action if we don't count the manipulation in number 5. Observe that these two sets of lines converge to a same point marked by the second red square. Notice also that the lower orange line acts as a non-obvious sloping support and resistance line if you pay attention to the small tails along the way. I talked about the idea of reverse engineering your entry and exit points. This is what I'm referring to when I talk about these sloping lines. You can find almost an infinite number of these lines on the chart, but only a very limited number of them will correlate and converge to a same point like you see here. The other element that enriches this context is the set of lower tails right above the second red rectangle. These lower tails give the impression that there is some sort of barrier in that level, and this barrier seems to be giving support to the upside. Finally, the last element that you should consider is the outside candle marked by the vertical gray line. This clearly shows intent to the upside after both long and short retail traders were washed out of their positions. The trade you see opened in the chart was triggered at the open of the very next candle with a stop below the low of the outside candle. Just as an observation, this outside bullish candle is also a fractal candle by the light of the fractal flow method, so if you understand how both methods work, you would have yet another layer of confirmation to enter this trade. The target was placed around high number 6 level to give about 1 to 3 risk-reward ratio. Let's see how the market responds. Here we can clearly see the outcome of our long position. One very important point about these manipulations is that sometimes, we have to wait for both sides of the market to get hurt in some way or another, and then we can act, otherwise we will end up being hurt as well. In this example, you could see that after both sides were whipsaw, the smoke cleared and we had headroom to make a profit without being maneuvered.